The ideal is if you want full repatriability, NRI plus PIS. You can have only one PIS account in India. More paperwork, more costly to maintain.
It's when you hear all this stuff that you realize the importance of GIFT City. To be very honest.
Yes. This entire alphabet soup of jargon just becomes irrelevant.
Yeah.
There is no concept of NRE, NRO accounts there. Both these problems are solved with a GIFT City FD. You can have a foreign currency deposit with tenures as low as 7 days. And can go up to like 5 years, 10 years, whatever.
Right.
A 6% USD FD is equivalent to having like 9.5% in INR. And again, this is tax free.
Yeah.
The minimum investment required is just $500.
Coming down from 150,000.
Yes. And additional investments are just $100.
Understood. Okay. And can we access US stocks from GIFT City? So now, one concept that became very viral last year was DTAA.
Yeah.
The Double Taxation Avoidance Agreement, right? So could you please give us or tell our viewers what DTAA is and how it works?
Yeah. So
now let's talk about the investment options available in GIFT City.
Yeah.
Right. So what are the investment options available right now?
So again, we can go vertical by vertical. So let's say we talk about banking. So in banking, you can open a dollar savings account in GIFT City. You can open a dollar deposit. You can also open savings account in some other currencies, some other popular currencies like let's say pound and euro as well. USD again is the most popular one. So on the banking side, you have accounts and deposits. On the investment side, there are mutual funds. There are AIFs, which are again like sophisticated mutual funds with higher ticket size and all of that. Those are actually the ones that started earlier. This year onwards, we have retail mutual funds also available for NRIs. Again, two types. There are funds that invest in India, which are the India focused ones. There are also funds that invest abroad. They are like global investing funds. So on the capital market side, these are the two main products. The other is that via GIFT City, you can also invest in US stocks or global stocks for that matter.
Okay.
Right. So GIFT City is sort of serving both, India focused investments as well as global investments for, NRIs.
Right. So one question here. So when it comes to GIFT City FD, so what is the typical interest rate that is going on, plus what is Belong offering right now?
Right. So the typical interest rate that you get in GIFT City, and right now there has been a series of Fed rate cuts, so interest rates have been on the decline. The typical interest rate, I would say, from major banks is, between 4 to 5% in US dollar terms, right? At Belong, we are offering as much as 6%. Right, and that's something that we have. We have a good partner bank, with whom we are able to sort of provide these rates to our customers.
Now, one important thing to note here is it's USD denominated.
Yes.
Which means the 6% can effectively become like 9%.
In INR terms. So for example, this, let's say, again, if INR continues its a trend of depreciation that it has, and let's say it depreciates by another 3.5%, then a 6% USD FD is equivalent to having like 9.5% in INR. And again, this is tax free.
Yeah. So in Indian, okay. Otherwise, it's taxable, right? Yeah. Okay. So that becomes the gains keep on increasing.
Yes.
Okay. Understood. All right. So that part is clear. Let's come to mutual funds, right? Retail mutual fund. Belong recently started. Included the Tata AMC mutual fund, right?
Yeah.
So can you please give an idea about that particular fund?
Yes. So as I said, until now, most of the funds that were in GIFT City, or almost all of the funds that were in GIFT City, have been AIFs or alternate investment funds.
Yeah.
These are funds that pursue sophisticated investment strategies and are meant for high net worth investors. The minimum investment required for these funds is 150k USD, right? Which is almost 1.25 crores, right? Now, starting this year onwards, there are mutual fund companies launching retail mutual funds. And Tata AMC has been the first to launch a retail mutual fund out of GIFT City, which is India focused, right? So they will be investing in India,
right?
So the name of the fund is Tata India Dynamic Equity Fund. The ticket size, since the retail fund, the minimum investment required is just $500.
Coming down from 150,000.
Yes, and additional investments are just $100, right? So very, in that sense, like huge decrease in the ticket size that is required for investing, into this fund. The fund itself is a diversified fund. It invests in Indian mutual funds of Tata. So it's like a feeder fund. It further invests in Tata's funds, and which are sort of diversified. So it can be large cap, mid cap, small cap, and sometimes even sectoral bets. They can even include gold, etc. So it's a very well diversified fund. You get access to entire growth story of India, right? With just $500. And again, the best part of this is that since this is a GIFT City based India fund, for NRIs, this is completely tax free.
Right.
So any gains that you make from this fund are not taxable in India, right? You may still, depending on where your country of residence is, you may have to pay taxes there, but not in India.
Right.
Which also means, for example, if you are a resident of a tax-free jurisdiction, like UAE or let's say Singapore, then there also you're not paying any capital gains tax. So effectively, the entire thing becomes tax-free for you. And this is one of the major USPs of GIFT City when it comes to investing. And which is why in the next 6 months you will see more and more such retail funds coming.
So you just mentioned about Indian mutual funds and GIFT City mutual funds, right? A fundamental difference.
Yes.
So what are the major differences? You can list all the differences you can think of. While if an NRI is investing in an Indian mutual fund versus the GIFT City mutual fund.
Yeah. So some of the small differences first. So for example, an Indian mutual fund is INR denominated. A GIFT City mutual fund is USD denominated. And as we spoke about, some pain points that NRIs have, which GIFT City is solving for. So, in order to avail of an Indian mutual fund, you have to go through that whole NRA, NRO hassle, and then, taking money out of that, repatriation and all of that. So, for a GIFT City based mutual fund, all of that is not a problem, right? There's no NRA, NRO hassle. There's no, limits on repatriation and all of that, right? So those are, some, differences. Now, the most important difference or the biggest difference is on the taxation.
Yeah, you just mentioned that.
Right. So now, as an NRI, if you're investing in an Indian mutual fund, right, whether you are investing through your NRE account or NRO account, it doesn't matter. You are taxable on the capital gains.
Okay.
Right. And the way it works is that there will be a TDS as soon as you redeem that investment. Right. And this is also something that we, touched upon earlier.
Yeah.
So let's say if you have 1 lakh invested in an Indian mutual fund, even through your NRE account, and now you redeem it, right? You sell it. So the mutual fund company will deduct the TDS, and in your bank account you may get only 85,000 or 90,000. The rest of it has been deducted as tax.
Right. Okay.
Right. Then at the end of the year, you have to figure out that how much was the actual tax liability. Right. Maybe the actual tax liability was only 5,000 rupees. Right. But it has, deduction has been of 10,000. Then you have to file your ITR and claim it.
The whole new paperwork stuff.
Yeah. Do that paperwork, claim a refund.
Yeah.
The same thing in GIFT City, it is, not taxable only in India. And there will not be any deduction.
Okay, you get a full amount.
You get the full amount. So you don't have to, you get the full amount. You don't have to wait for a refund, or you don't have to wait for filing ITR and all of that. Right. And, that is like the biggest difference. You may still have to pay taxes in your country of residence. That part is common anyway. That doesn't change whether you are doing it in an Indian mutual fund or a GIFT City mutual fund. But at least on the India side, there's no tax liability to worry about.
Got it.
Again, this is only true for GIFT City based mutual funds that are investing in India and specifically Indian mutual funds.
Okay.
Right. There are GIFT City based funds that might invest abroad, or there are GIFT City based funds that might invest in private equity and all of that. It's not for that. This tax exemption is only for inbound feeder funds into India.
Right. Now you said currently there is only one retail fund in GIFT City, which is Tata's
Yes.
fund, right?
Yes.
And you said in the future, in the coming months, we can hopefully see a lot more funds coming in. Now, question is, the Tata fund is for NRIs who want to invest in India.
Yes.
What if an NRI want to access the global market? So is GIFT City an option for them?
Yes, definitely. So GIFT City is an international financial hub. That is how the whole thing is being, progressing, right?
Right.
So while for NRIs the primary draw, can be India-focused mutual funds, there are also globally focused mutual funds that invest in global markets. And NRIs can invest in that also. The taxation there works slightly differently, and maybe difficult to get into it in this episode, but that is definitely an option. It's an option that is gaining a lot of interest. It's not something that we initially thought NRIs would be interested in, because maybe wherever they are, they already have access to global investment products. But yeah, NRIs, not all NRIs live in the US.
Yeah.
Right. There are lots of them in many other countries, right? And in South Asian countries, there are NRIs in Africa, LATAM. They don't have that easy access to US markets. In fact, even from Middle East, right? There are a lot of NRIs there, obviously, and they are looking for an easy way to invest in the global markets. Right. And GIFT City is a platform for such investments as well.
And if something like this coming in India, NRIs will definitely love it,
yes,
right? So
definitely.
Yeah. So we started by calling FDs boring, right? And then we discussed about mutual funds, which got interesting. Let's talk about stocks. That's the most interesting stuff here, right? So is investing in stocks possible through GIFT City?
So the answer is yes. So I'll just again take a step back and just explain this to you. So GIFT City has its own exchanges, like how in India you have NSE and BSE as the two primary exchanges where most of the Indian stocks are listed and traded. Similarly, GIFT City has its own exchanges.
Okay.
And in fact, they are subsidiaries of these exchanges only. So there is an NSE International Exchange. There is an India International Exchange, right? Now the difference is that the stocks that trade in India are not the same that trade in GIFT City.
Because GIFT City is not India, right? Yeah.
Because GIFT City is not India. These are separate exchanges in their own right, and they have their own instruments listed there, right? Right now, there are not many equity options available there, but there is an upcoming IPO that is lined up in GIFT City.
Right.
What that means is that this is a company that will get listed in GIFT City. They don't have a listing in India. GIFT City is the only place that they are getting listed. So GIFT City exchanges are the only place where these companies' shares will be available and traded.
Right.
This is the first such IPO that will happen this year. And after that, there are multiple such IPOs planned. Right. And all of this, will make, GIFT City also an attractive place for companies all over the world, including from India, to get listed and access, foreign capital. Right. So over time, again, the vision is, and we see that happening, is that it will have its own equity market, which is separate from India. Right, where you will be able to access companies that are not even listed in India, but they are companies that are abroad, or a lot of tech companies are looking to get listed in GIFT City. So it will have its own equity market.
Now these companies, should they be based in GIFT City? That's the whole idea.
No, that's not a requirement. They can be based anywhere in the world. The first company that is being listed is actually an Indian company. So only NRIs can invest in it. Then upcoming, we know that the companies that have shown interest some are US based companies, some are European companies, looking to get listed in GIFT City. The primary attraction for them to get listed in GIFT City is, think of it how in the early days when when Make My Trip got listed, right? They got listed in the US, not in India, right? So there are companies who want to tap foreign capital, right? And since GIFT City is developing as an international financial hub, right? Through getting listed in GIFT City, they will be able to tap foreign capital and not just Indian capital.
Understood. Okay. And can we access US stocks from GIFT City?
Yes. So one can invest in US stocks through GIFT City. It comes under their global access program. What that entails is, so US stocks are listed in the US, right? They are not listed in GIFT City. So in order to invest in US stocks via GIFT City, the arrangement is that you can open a US broking account via a GIFT City broker or via GIFT City platform, even such as Belong. Right. So through Belong, you can open a US brokerage account or a European brokerage account, and then invest in US stocks via that.
Okay. So IPO, US stocks, so Belong will bring in all those products.
Yes, definitely.
So in the future, we can apply for a GIFT City IPO through Belong.
Yes.
Something we can expect
very soon.
Very soon. All right, cool. Okay. Now, I want to ask a generic question, and this should not be investment advice. It's just your opinion. So how should an NRI plan their investment? Like, what are the different assets they should consider, and what percentage should they allocate to each? So your personal opinion.
Yeah. So the way I think about it, and this applies to anyone, not just an NRI, is that the starting point has to be two things. One is, what is your risk profile or risk tolerance, right? Some people are only comfortable investing in, let's say, fixed deposits where there's almost no risk involved. Some people are comfortable, doing stocks directly. So that is the first thing you have to consider, right? And also, there's a Warren Buffett quote that risk comes from not understanding what you're doing. Right. So that is also something that you have to take into account. Like I've spoken to a lot of NRIs, who feel the pressure that they should be directly investing in stocks and all of that, but they don't understand anything about it. Right. So for them, investing in stocks is going to be super risky. Right. While investing in stocks for, let's say, someone who is much more well-versed may not be as risky because they understand what they're doing. Right. So first you have to understand what is your risk profile. What are the financial instruments that you understand? Whatever you don't understand, right, that is something that you should avoid till the time you understand it. So one way to approach it can be that, okay, today I will start investing in, let's say, only fixed deposits and mutual funds, because those are the only things that I understand. I do aspire to invest in stocks, but for that, let me first develop my understanding of stocks.
Keep learning,
right? And then once I get there, then I will allocate, some of my portfolio to it. So the first is just the risk profile. Don't give in to the FOMO. Don't give it into the peer pressure. Just stick to what you know, and gradually, if you want, you can increase your understanding of what you don't know if you are interested in something.
Okay.
The second part of, again, investing is that what are your goals and objectives of investment? So for example, you may be investing for your child's education. You want to build a corpus for that. Or you may be investing for your retirement. Now your child's education requirement may be just 5 years down the line, whereas retirement may be 15-20 years down the line. Right? So the investing for these two cannot be the same.
True.
Right? So your goals and your time horizon for those goals will determine what kind of investments you can make for them. Right?
Yeah.
So now take these two things together, understand your risk profile, write down what your goals are, what you are investing towards, and then your asset allocation, the choice of investment products that you use should be based on this. So just to give a practical example, right? Let's say you have a moderate risk profile, right? That okay, you are okay with some ups and downs, but you don't want like your portfolio going down by 50% if there's a market crash, right? And let's say your goals, you have multiple goals. Let's say there can be a short to medium term goal of putting down a down payment for a house purchase, or let's say retirement, which is 20 years down the line, right? So now if you have a short to medium term goal and a moderate risk profile, then you should have not, let's say, more than 50% in equity products, right? The longer the time horizon and the higher the risk profile, you can tilt it more towards equity.
Right.
Right. And when I say equity, I mean it can be mutual funds, it can be stocks, again, depending on your risk profile. Right. So this is how I think about asset allocation and investing.
So I think one problem is when people see gold going up, they want to invest in gold.
Yes.
But the problem is they might be buying at a peak.
Yes.
Right. So this happens with everything.
Yeah.
So right now, stock market is not the point of discussion. So people stopped investing in stocks, but this might be the best time to start investing.
Yes.
Right? So this thought process is something that people should be aware of.
Yeah.
Right.
Yeah.
So what do you think about assets like gold or real estate?
So again, when I look at what assets to invest in, that decision should not just be based on returns, and definitely not the recent returns. But there are several factors that should go into it. Returns is definitely one of them. Then what is the risk profile, right? Like how variable those returns are. The third is what is the taxation involved, right? Like there are some so investments like equity are more have lesser taxation than let's say investments like gold and real estate, right? Because usually the government wants to promote more investment into capital markets, right? So taxation should definitely be taken into concern. The fourth thing is liquidity.
Very important.
How easy it is to liquidate that investment. Right. So when I look at a particular asset class or particular investment, I want to evaluate from all these perspectives. So then when you think of, let's say, something like real estate, right? From a returns perspective, I would say it sits somewhere between like an FD or a mutual fund. Right. From a risk perspective, again, maybe similar. Not as safe as a fixed deposit, not as risky as, let's say, an equity investment like mutual fund. Right. From a tax perspective, slightly worse than equity, better than FD. When it comes to liquidity, that is where it like scores really low. And that is then you have to think that, okay, then you shouldn't allocate majority of your portfolio in just that real estate, and especially not just like one property, because you can't sell half a room. Right, if you need some money. Right, and then you will be forced to liquidate the entire thing, and most probably you will have to, because you want to sell it fast because there is some need and all, then you might have to sell it at a worse price. Right. So you have to think of all these factors when choosing a investment product. Coming to gold, right? Obviously everyone knows how it has been performing. Gold generally performs well when there is economic uncertainty, right? And of late there has been a lot of economic uncertainty, and this is what has driven up the price of gold. If you look at let's say the last, before the rally happened, and the previous 5-10 years, then there was almost no appreciation or little appreciation, because again the political uncertainty was probably not that high. Economic uncertainty was not high. So while again diversification is always a good rule of thumb, you should always have, let's say, a bit of fixed income, bit of equity, a bit of gold in it, but right now may not be a time to over allocate to it. Right. In fact, if at all under allocate to it, over allocate to maybe assets that have not been doing that well, which may do better in future, because at a long enough time scale, there is sort of mean reversion that happens over time.
And maybe this can be a good time to maybe rebalance your portfolio.
Yeah. So actually that is why. So let's say if you had both gold and equity in your portfolio, let's say, and assume that when you started it was 50-50, and let's say that was your desired allocation. In the last few years, gold has run up much faster, right? So its weightage in your portfolio would have grown to 60, 65, 70%, right? Yeah. Your desired asset allocation is 50-50, let's say. So then when you rebalance, what is it exactly that you will be doing? You will be selling gold and buying equity.
Yeah.
Right?
Yeah.
You're not adding more to gold, right?
Yeah.
So that rebalancing is exactly doing that, right? You are selling assets that have run up much faster than their average in the past, and you are adding more to assets that are performing below their average in the past.
Yeah. And then again, the problem here is Indians invest in these assets the wrong way, right? So, for example, gold, jewelry is the most desired.
Right.
You instantly lose like 20% when you buy. Yeah. So even if the gold, goes up 20%, it's 0% net, right? So again, rebalancing might not be possible. So take wise choices while
definitely. Right? And I think it's always good to have that clarity that I'm buying this from a consumption perspective or I'm buying this from an investment perspective.
Yeah, true.
Right. So I think that clarity helps a lot. If you're buying it from an investment perspective, don't buy jewelry.
Yeah.
Right. You can buy it in a different format.
True.
Right. And which then, will be useful when you are rebalancing.
Right. Yeah. So now we've discussed in detail about banking side and the investment side. Now let's talk about taxation. I think we covered this initially for a little part because we spoke about TDS deduction. Yeah. How does it work? We have covered that portion, right? So now one concept that became very viral last year was DTAA.
Yeah,
the double taxation avoidance agreement, right? So could you please give us or tell our viewers what DTAA is and how it works?
Yeah. So again, this concept is more important when we talk about cross-border investments, right? Which is, what NRIs end up doing when they move abroad and they are investing in India, right? So the basic concept is that any income is taxable at the source and at the destination. Right? That's like the basic fundamental concept. Now, typically for resident Indians like us, our source and destination is both India. So there's no double taxation. There's only one taxation. If you're an NRI, right, your source of that income is, let's say, India, but your destination, which is where you are residing, right, you are the recipient of that income, is some other country, right? So now it's taxable at the source as well as the destination. See, both governments want to claim their own share of it, right? So this gives rise to double taxation. It's the same income, but it is taxable in the country of origin as well as in the country of receipt, right? Now, obviously, that's not desirable, right? If this were allowed to exist, if both countries are taxing it fully, right, then that will severely hamper any cross-border investment and all, right? So now what is the solution? The solution is that then countries came up with these bilateral, which is like one-to-one agreements called DTAAs, which is the double taxation avoidance agreements, right? Where the concept is that, okay, let's not tax the same income twice, right? So here, how it works is that, so again, taking the case of let's say an NRI, living in, let's say, UK, right? So the country of residence is UK, and this is not specific to UK tax laws. I'm just using it as a general example, right? And let's say investing in India, right? So the way DTAAs have three types of provisions related to tax, right? One is a complete tax exemption
Okay.
on one side, right? So certain DTAs have certain very favorable clause where a particular type of income is completely exempt from tax in one of the two countries, right? So again, understand that DTA is a bilateral agreement, right? So India has more than 100 DTAs. There's no single DTA. So India UAE has a India UAE DTA.
Okay.
India UK, there is a India UK DTA.
Okay.
India US is a separate India US DTA, right? So these are like one-to-one arrangements.
And everything will be different.
Everything will be different.
The terms will be different.
Yeah, there will be overlaps and some common things and all of that, because these are best practices that have evolved over time.
Yeah.
But each is a different agreement. Right? If you are an NRI in UK, you can't rely on DTA between India and Singapore to figure out what your tax liability is.
Okay.
Right? So now so bilateral agreements, each one different. There may be overlaps because of how international practices have developed. There are three, as I said, there are three types of tax benefits under a DTA. One is a complete tax exemption, which is the rarest one, right? And this is the one that got popular, right? So there are certain countries like UAE and Singapore, which have a very favorable clause in their respective DTAs that capital gains from investments that are not shares, so which not directly stocks, but let's say mutual funds, are tax exempt in India. And anyway, these countries don't have their own capital gains tax on these, so they become completely tax free. Right. So one sort of exemption is the complete tax exemption, which is the rarest, and obviously because it's the most beneficial. Like, why will a country give a complete tax exemption on certain income? Because of historical reasons, some of these DTAs have that exemption. Okay. Which is what UAE and a lot of other Middle East countries and Singapore and all enjoy. The second one is the lower taxation, lower rate of taxation. Right? So you have clauses in certain DTAs, and these are more common. That if so for example, I think even in the US and India DTA, there is a clause that for a US based NRI, interest income originating from India, right? On the India side, it will be capped at X%, which I think is around 15% or 20%. The Indian tax on it cannot exceed that. Right? Now on the India side, if you see, the interest income is taxable at your slab rate. So if you're in the 30% tax bracket, the interest income is taxable at 30% in general. But you can invoke this DTA clause to say that only it should be capped at 20% as per the DTA signed between, say, India and US. So that's the second one, right? Which is lower tax rates. The third, which is the most common and in all the DTAs, is tax credit. Whatever tax has been paid in one country can be claimed as a tax credit in another country, so that you don't have to pay extra tax, like double tax. So for example, let's say certain income is taxed at 10% in India and 20% in US. Without this DTA, if you will have to pay 10% here and 20% there, total 30%. Right? But with the DTA, the 10% that you pay in India can be claimed as tax credit in US. So you only pay the remaining 10%.
Got it.
So your total tax does not exceed the 20% that you are supposed to pay. So this is fundamentally how DTAs work.
And what are the process to claim DTA? How to evoke DTA?
Yes. So there are the one of the ways that in which it can work is, again, for NRIs, as we discussed, everything is, or most of the things are TDS based. There's an upfront deduction of tax, right? So even in an NRO fixed deposit, there's an upfront deduction whenever the interest is paid out in the form of TDS. If you're investing in mutual funds, whether through an NRE account or NRO account, there will be an upfront deduction of TDS. So one of the ways which it can work, and more so with the banks, that you can give them a tax residency certificate, right? That, okay, I am the resident of so and so country, let's say US. So do not deduct TDS at your normal 30%, but deduct it at the lower, let's say 20% as per the DTAA. Right. So you will have to, sort of do that with your bank, submit the TRC, and TRCs are generally valid for like 1 calendar year or, whatever financial year the respective country follows. So you will have to keep resubmitting it. But there is a provision that banks can accept it and deduct lower TDS. Okay. Let's say if that is not a option available and there's a full TDS, then while filing your income tax returns in India, you can submit the respective TRC and fill something which is called a Form 10F to claim the balance refund. So let's say the tax should have only been 20%, but the bank has deducted 30% or the mutual fund has deducted extra. It was supposed to be completely tax-free under the DTAA and the mutual fund has deducted something. So you can, while filing your ITR, you can give the TRC, you can fill that Form 10F and you can claim the excess tax as refund.
Okay. All right. And does this involve any charges, this entire process of DTAA submission? So let's speak from maybe US and UAE, right? So that people get a sense of it.
Right. So what are the things you require to file, for the DTAA benefit? See, on the, so where are you filing? Let's say, again, you are filing it, with the Indian IT department, right? There you need to file it with a Form 10F and the respective country's TRC, which is the tax residency certificate, which is what actually proves. So it's basically an attestation that the foreign country is giving that, yes, this NRI was resident in my country for X number of days, right? Which is the actual proof of your residency. Just having a visa is also not proof that you actually were resident of that country in that particular time frame, right? So you need this TRC. So on the India side, there are no charges. Obviously, if you hire someone to do it for you, you will have to pay for their services. If you're doing it yourself, there's no charges on the India side. What happens is obtaining this TRC from your foreign country of residence, that may be chargeable. So for example, in UAE, UAE it is more costly. UAE it costs almost 1,000 to 1,200 dirhams for one TRC, right? And remember that it's an annual thing, right? So for every TRC you have to pay that much. So it's about 20,000-25,000 in rupee terms.
Right.
But there are countries where a TRC is practically free also. So I think Singapore is not that expensive to obtain a TRC. So that depends like from country to country.
All right. So we spoke about DTAA, right? But when it comes to GIFT City, all this goes away, right?
Yes.
So now one question I have is, there's an NRI in UAE, in the US. Does GIFT City treat both of them equally? Can both of them access GIFT City equally? Because in all the other places, there's a huge distinction, right? It gets tough if you're a US NRI. It gets easier if you're in UAE. So how does GIFT City treat NRIs from different countries?
Right. So the first point on the DTAA, right? So with GIFT City, think of it as all the DTAA benefits that India has ever extended to any country via the DTAA agreements is already built into GIFT City. That's the biggest thing. So now you don't need to do anything from your side to avail of any DTAA benefit. Right. Everything is already inbuilt.
Okay.
Right. So for example, if there is no tax liability for an NRI in certain product, that means there will not be any TDS. You will not have to file for a refund. You will not have to submit any TRC. Right. So GIFT City is like the culmination of all DTAs that India has ever signed. Automatically it comes out of the box with GIFT City without you having to do anything from your side.
Right. Okay. And again about US.
So now coming to an NRI in US, so that is actually more of a distinction from a US side rather than an India or GIFT City side. So the challenge that US based NRIs face when investing in India is more because of US regulations. and not India regulations or GIFT City regulations. So US also wants to discourage its residents from investing outside US. Right? So what they do, so what India does is by putting capital controls. You cannot move more than X amount of money outside India and all of that. US does not do it via capital controls. US discourages its residents from investing abroad by punitive taxation. That okay, if you are investing abroad, right, even if it's a mutual fund, you will have to pay tax at your slab rate and not capital gains tax. Right. So that is how US operates. Or the other thing is that okay, even if it's a foreign fund, it has to register with me for my residents to invest in that. Right. Otherwise, there can be some penalty on the fund itself. So that is how US discourages its money from flowing abroad. So all the restrictions that we hear about US NRIs not being able to access in products is mostly coming from that. Now here there is a slight hope or benefit with GIFT City, because in GIFT City all the mutual funds that are set up are being set up from a global perspective. They know that unlike in India, where most of their investments come from resident Indians, and NRIs probably make up only 2-3% of their AUM, in GIFT City they know that primarily it will be NRIs. So these mutual fund companies are actually making efforts to register themselves in different jurisdictions. That okay, I will register with the US government. I will register with the UK government. So that my investors, get the same treatment as if they were investing in a US-based fund or a UK-based fund, or at least not as punitive as it used to be. So yes, GIFT City, will have more funds over time that will accept, let's say a US-based NRI also as compared to India. But again, we have to understand the source of those differences are on the foreign country side and not on the India side.
Understood. Clear. Okay. So I think we have covered almost every topic that I had in mind. And I'm pretty sure that, every NRI will find this useful. So Ankur, I'm really excited to know what's happening at Belong right now.
Yeah. So we are super excited about all the stuff that we are working on. Being in GIFT City and one of the first, apps to come out of GIFT City, we are like right in the middle of all the action in GIFT City. We already have the USD fixed deposit for NRIs. We have launched the first mutual fund for NRIs. And by the time this video is out, we are going to have alternate investment funds. We are going to have global investing for NRIs. And even the first IPO that GIFT City is going to see, that is going to be available on our platform.
Right. Super excited to see this. On my channel, I get a lot of requests from NRIs and NRIs from a lot of countries, asking when Belong will, be available in their country. So all the very best. And thank you so much for your time. It was a very insightful session.
Yeah, I enjoyed it a lot. Thanks, Aswin, for doing it.
Thanks so much.
Okay.